Hey guys, how's it going? It's Andy from Magoo Investing. Happy Friday. It's always fun waking up in the morning, getting on Twitter and seeing that hashtag stock market crash is trending. And then you look at the overall market and it's down like 2%. And it's really funny because just like a full year ago, the stock market was actually crashing, but we're seeing a lot of panic today. And in today's video, I kind of wanted to talk about some of the main catalysts that have been pushing the stock market down overall, because compared to what we've been seeing in the past year, this is not actually pandemic related. This has to do with some of the responses from the Federal Reserve to try to combat some of the problems of the pandemic. It is really interesting because we've gotten to the point now where the NASDAQ, which is the tech-heavy index, is down for the year. It's in the red. And we got to the point yesterday, it was like during the middle of the day, where we got into correction territory. A correction is a move that's 10% below what the all-time high was. So we got very close to that. It did not close that level, but it got to the point and made me start thinking, I'm starting to get more and more comments of people asking, is this the bottom? Should we start buying in? And I'm going to be giving my opinions on the overall stock market, because I have been very vocal for the past couple months about why I've been keeping a majority of my portfolio in cash, because I've been expecting a move like this for a long time. And while I don't think that we're close to where we're going to end up, it's a good time to start talking about the plans that I'm making. So in today's video, I'm going to be talking about the catalyst that I've been pushing the stock market down overall, kind of explain what's happening. Two, I'm going to talk about some important things to remember when buying in as the market falls. Because when I look around, I see a lot of people talking about buying stocks that I would not personally be touching right now. And then part three, I'm going to be talking about what my plan is going forward and some of the stocks that I'm targeting to buy as the stock market falls overall. So is the stock market crashing right now? No, but there's a lot of misinformation about what a stock market crash looks like. And I want to talk about some of the wording that you'll often hear around investing in the stock market. The first one is a correction. A correction is a 10% move to the downside, and it usually results in just some normal market movement. At this point, we've gotten very close. On Thursday, the market closed down like 9.6% from its all-time high, so it's very close. A bear market is a move that's 20% down from the all-time high, and that happens every couple of years. And we had the shortest bear market in the history of the stock market back in March, and I think it lasted like a month and a half until the market got to a new all-time high, which ended the bear market. And then we have a market crash, and a stock market crash is a term that gets thrown out a lot, and there's no real number that defines what a stock market crash looks like. But in my mind, a stock market crash has to do with how violently the stock market moves to the downside. You could have the market give up 30% of its value over the course of 6 months. I wouldn't call that a crash. But when we think back to last March, when the stock market fell like 35% in the course of like 4 weeks, that would be a crash. A crash has to do with how quickly the stock market falls and not the actual number amount. So we are now into correction territory, and that's going to be something to watch going forward. Whenever the stock market falls, I think it's important to kind of step back and look at what catalysts are pushing down the market overall, because sometimes it's just the natural movement of the stock market to start selling off, especially as we get towards historic levels or we're reaching all-time highs. And yesterday, the big catalyst had to do with Federal Reserve Chair Jerome Powell, and he came out and had some statements that it's really interesting, because both sides of the coin, the people that are trying to reduce inflation, we're not happy, and the people that are trying to keep the stock market up, we're also not happy. So it's really interesting to see both sides of the coin being kind of upset with what Jerome Powell said. So yesterday he spoke about the plans of the Federal Reserve. He said the plan is to keep interest rates near zero until we've reached maximum employment and the inflation rate reaches around 2%. At this point, we are still way below the 2% inflation rate. It's actually been below that level for the majority of the past like 5 to 10 years. But he did see that some of the bond movement did kind of pique his interest. And so he's going to be watching that going forward. And so he expected to see higher rates of inflation going into the summer. And a lot of investors took that comment as meaning that they expect that the Federal Reserve is going to have to raise interest rates by the time we get to the summer. And we'll talk about what that actually means. So here's why inflation can be bad for the overall stock market. As inflation goes up, the value of the dollar decreases. And so people are not as able to buy as many goods. And it may seem like, oh, you know what, the money doesn't really change, it just decreases in value slightly. But we know that the minimum wage has not changed with inflation. It means that the lower income areas do not have as much buying power as they did before. And so when you're looking at the overall market and trying to predict consumer spending, inflation is not good for spending overall. And so for different stocks, what inflation will mean is that revenue is going to look decent for a bit, but it means that companies are going to really be struggling when it comes to profits and earnings. Because as inflation goes up, usually those are the two metrics that you see go down. And so one of the ways that you see inflation be affected has to do with an influx of money to the overall economy. And the place that we've seen that in the past year has definitely been the stimulus packages. And so this is the Federal Reserve pumping money into the overall economy to try to boost as much spending as possible, because as the pandemic hit, you're worried that businesses were going to really be struggling as people weren't going outside. And that was kind of the plan, to reduce interest rates to zero to promote spending, because if you've been paying attention to your savings account at all, you're making pretty much no money at all. And so that's the Federal Reserve trying to promote spending overall. And it's allowed these companies to borrow money because there's not really any downside like a high interest rate, because if you can borrow at pretty much zero, the companies that have the ability to pay that back reliably are going to be able to take advantage of that. But those numbers can't last forever. And I had a lot of people on my channel asking if I thought that was going to be the catalyst that pushes the market down. And I didn't really think so, because while you cannot keep interest rates at zero forever, we have kept them at zero for a majority of the past decade. And it was only back in like 2018 when interest rates first started climbing. So we've been at zero for a long time, so I'm not super worried about that, but it is the inflation that I'm really worried about. And that's why these stimulus packages have had more of an impact on the Federal Reserve's decision than the actual keeping interest rates at zero. And one of the things that people were talking about in his comments from yesterday has to do with the maximum employment levels. And based off of the numbers that we've been seeing so far, the expectation is that we're not going to reach those numbers until the end of this year. So that's going to be a long way away. It's definitely going to be the inflation that's going to be the thing that people are going to watch going forward to determine if we're going to have to raise interest rates. And when that happens, that's going to be a pretty big move to the downside, is my expectation. But what's really interesting so far is the areas of the market that have been selling off. In 2020, the winners by far were the tech-heavy NASDAQ, which was up 43% overall, which is an incredible year when you take an average of 100 stocks. But so far in 2021, the areas that have sold off aggressively have been the tech-heavy stocks. And so at this point, the Dow Jones is still up, and you compare it to how well it did in 2020, being up only 7%, it makes sense that people are taking profits, because the areas that did very well in 2020 might not be poised to do as well going into 2021. So let's move on to part two, where I talk about some of the important things to kind of consider as the volatility and just the market moves overall. And the main thing for me with this change in the market is I am done with speculative stocks. I've been done with speculative stocks for a bit, but this has been a great example of when things are going well, you can bet on some of these diamond in the rough stocks. That's why this past summer, when things were going pretty well, the money supply was looking really good, and the Federal Reserve was trying to boost spending as much as possible. That's why I aggressively went into companies like Sonos that I thought was in a fantastic spot to do well during this time of an economic boom, or at least the trying to promote an economic boom. And I did very well in that position. But at this point, I think speculative stocks are off the table for the time being. One of the best examples of a speculative stock has to do with Virgin Galactic stock, which is ticker symbol SPCE. This is a fully speculative stock because it's mainly focused on commercial space travel, which is still a long way away, and they don't really have a lot of reliable revenue coming in. It had a fantastic run to the end of 2020, but it has been selling off aggressively so far in February and going into March, as the market has switched from investing in these speculative stocks and moving more towards value and the stability of a blue chip stock. So we've seen that with something like a Virgin Galactic. We've even been seeing that with Tesla, which was one of the high flyers of 2020, being up almost 700% overall. But as of right now, it's down 18% on the year, and it doesn't have anything to do with a changing of how successful the company's been. But areas that did very well in 2020 are selling off because people made a lot of money there and they want to lock in those profits, because the areas that are going to sell off the most aggressively are the ones that put on a lot of value in the past year. And so speculative stocks, I do not think, are a great spot to invest anymore. We're going to be watching them to see when the market eventually bottoms out, to see if we can buy back into those speculative stocks. But for right now, speculative stocks are off the table for me. So what am I going to do with the overall market? Because I get a lot of questions asking, is now the time to buy in? We've been seeing some of my favorite stocks be at a discount that I've mentioned in previous videos. But right now, I am heavily invested in cash. I'm sitting at 45% of my portfolio overall. So I've been waiting for this drop for a long time. But I think the main thing to think about is I'm going to be as patient as possible. When I was learning to swing trade, there were 3 different types of entries that you could take to kind of determine where you wanted to buy in. And buying into the stock market is probably the easiest part of the stock market, because you can make as many narratives as you want about why now is the best time to buy in. So let's talk about the 3 different zones, because I think it's an interesting way to kind of discuss when to buy into the overall market. So entry number 1 is buying right as it reaches its zone. These zones, if you've ever seen me draw lines on the chart, a support and resistance, in my mind, is not just a solid line. It's usually a range of different prices where the prices are all based off of where people are buying and selling. The second that you break into that zone and buy in, that's considered an entry number 1. And the whole idea is that anytime it goes into that zone, you're going to be buying in. What that does is you get as many trades as you possibly want. The second that it goes into that area, you buy in. But what are the risks of that? If the stock continues to fall, you're going to be holding at a worse price instead of just waiting to see what actually happens. Entry number 2 was waiting for the actual bottom of the stock or the overall market. This is easier said than done. I was pretty good about picking the bottom last year. I think I bought in on April 1st and the market bottomed on March 23rd. So I did pretty well with that, but it's really hard to pick the actual bottom. But the way that I'm looking to buy in is the entry number 3. That is waiting for the stock market to bottom and wait for it to start pushing up and out of that zone. And so what this means is you're going to have to be patient, because you have no idea when the stock market's going to bottom, but you're going to be waiting and collecting as much information as possible. One of the downsides is that you're not going to be buying in at the best price, but you're picking the trade-off of buying in when you think that the market's going to continue to rally higher instead of waiting to see, is it going to fall lower? So this is the safer approach in my mind, and that's what I'm going to be waiting to do because it's so hard to pick the bottom. I don't want to be buying in and having the market continue to fall, and so I'm going to be as patient as possible and wait to see when we find the bottom and wait for the push up, and then I'm going to start buying in. So I think we're still a long way away from that. If someone was looking at the overall market and didn't really care about the trading aspect of it, I'd be fine buying in right now. I would be doing dollar cost averaging where maybe I'd put in a certain percentage of my cash like in every week and just start buying on the way down. But since I consider myself more of a trader, I'm going to be patient. And here's the three concepts that I'm going to be doing as the market falls overall. Number one is I'm done with speculative stocks. I think the time has passed for betting on these speculative stocks because as we wait to see what happens with the Federal Reserve raising interest rates, I don't think those are the places to invest anymore. So I'm going to be waiting until the volatility stops and then maybe I'll take another look at speculative stocks. Number two, patience is a virtue. I think trying to buy in the second the market falls is always a bad plan. You're likely going to be buying in and the market's going to continue to fall. So I'm going to be as patient as possible, wait for the bottom, and then wait for stocks to rally for a couple days, and then I'll start buying in. It's going to hurt because I'm not going to be buying at the best price possible, but it allows me to feel more confident with my trades, and it's less likely that the market's going to continue to slide after I buy in. And then number three, I'm only going to be buying stocks that I love, not like. In the past year, I have shed off some stocks that I liked in the past but didn't love, something like a Planet Fitness that I thought was great for 2020, but now I have sold it off as 2021 has made it not look as attractive to me. So the areas that I'm going to be looking to buy are the stocks that I absolutely love, and it's not that frequently that they go on sale. Stuff like an Apple, Microsoft, Adobe. Stocks that have incredible track records, but it's not very often that you can see them go on to an actual discount. So those are going to be the stocks I'm watching to see as the market falls overall, but I'm going to be as patient as possible. And those are the three main concepts that I'm watching to determine when I'm going to be buying in and which stocks to buy. So let me know what you guys think about the overall market right now. Things are falling. We're starting to get some deals. Some of the top flyers of 2020 are on sale now, stuff like a Tesla. Let me know if you've been buying in there or you're going to be waiting to see what happens with the overall market. Thanks for watching. I appreciate all the support, and I will see you in the next video.